All right, so we're going to go ahead and get started. Welcome. This is Stacy Francis from Francis Financial. We are a fee-only independent wealth management firm and have a passion, absolute passion for helping women going through transitions such as a divorce of a husband or death of a spouse, and also working with couples that have transition, and it might be moving towards retirement, it might be kids going to college and having a new look at life. So we are here, and the more complex the situation, the more we like it because it makes us understand and feel like we can make a big difference in your life. We can add a lot of value. And that's our goal in this presentation today. We're going to be going through a lot. So definitely get your pens and papers out. We're going to be going through not only what has happened over this last quarter as well as this last year, but we're also going to be looking forward. And that's even more important of how should you be making smart investment decisions about your portfolio. So we're going to go ahead and get started with that. And you can see the first step that we have, a beautiful picture of us here, we're going to be looking at four different areas. So the market review, as I mentioned before, looking back, our investment outlook, that's looking forward, focusing on the most important things about making good choices with your finances, called focusing on the fundamentals, and then also about our a second opinion service, which is one of my favorite things to talk about. So the market review, wow, has it been quite a quarter? In fact, I think you remember very clearly something that is still very much in the news, and that is dealing with North Korea. We also have seen a record number of hurricanes as well, and as we saw both with Puerto Rico, throughout Florida. We even have a few hurricanes on the way. We've also had forest fires and unprecedented shootings. A very volatile time, and it unfortunately has created a lot of fear in individuals. But what hasn't happened is it hasn't impacted the market. And so let me show you a little bit about what the market did essentially during this last quarter. So you can see that the third quarter of 2017, the US stocks did very well. In those 3 months, they were up 4.5%. Developed international did even better. And developed international, just so you know, that is Eastern European Europe, Western Europe as well. It's England, Canada, Germany, France, more of those developed international nations and countries. And that was up about 5.62%. Emerging market stocks up almost 8%. That was the real exciting news that we saw was the growth, particularly in emerging markets. And then we have our US bond market up about 1%. And we're not too worried about that because we do expect that bonds will continue to do well, but we don't expect to have huge, heady returns like we're seeing, particularly in the international and US stock space. Bonds in our portfolios hold a really important position. It's not necessarily a position of getting the best investment returns from them. Bonds are essentially our airbag, our cushioning to our portfolio. So let's move a little bit more into US stocks. Um, the market returns have remained pretty darn steady, and you can see this is for the entire quarter. And each one of these lines that you see here show different, both political, economic, newsworthy events throughout these last 3 months. And I think what the biggest story here is that for the perspective of volatility in news, this last quarter was one of the most volatile quarters you could have seen with regards to all of the different news stories that have been coming out. However, what you're not seeing is you're not seeing a whole lot of volatility with regards to US stocks. In fact, US stocks, you can see they've had a, kind of an up and down, but nowhere near what we've seen historically. In fact, where we're at right now is we are finishing one of the longest expansions that we have seen since the 1950s. And the market has only had about 3 days where it's gone up or below, up or down by 1%. 1% is a relatively decent sized move, but it's not a significant move in the market. And as I said, we've only had a few days this year where we've gone anywhere close to seeing a 1% drop in the market. So overall, even though there's been a lot in the news, overall we haven't seen significant negative ups and downs in the market. So this again just shows you a little bit about the U.S. stock market, and it's led to a pretty unbelievable rally in the last 12 months. We've seen continuous 8 consecutive quarters of growth. 8 consecutive quarters. And like I said, we haven't seen this level of growth, this significant ongoing expansion in the US stock market all the way back. We have to go back to the 1950s when we saw as many quarters that we've seen this uptick in the US stock market. So that sounds great, and I think that that's exciting. But I think some people might be concerned. In particular, if we look at this, where are we seeing the most growth? Here you can see essentially the last quarter, which is this really beautiful teal color. So large company stocks have done well, about 4.5% return. And small company stocks did even better. In fact, over the last quarter, small company stocks were up 5.7%. For the year, pretty phenomenal rates of return. So, year to date, so this is from January 1st through the end of September, large company stocks have been up over 14% for this year, again, since January. And small company stocks are no slouch either. Small company stocks have done well as well, and they are up a little over 10%. So that's phenomenal. We're really excited about the fact that we're seeing such growth in those markets. But even among those, there is a split. So we just talked about large company stocks in general, up about 14% for the year. But if we break it into the two different styles of large company stocks, we start to see a change. We have large value up at 7.9% a year, and then we have large growth up over 20%. Large growth is where we've seen the biggest growth in the stock market. In fact, those names are probably pretty familiar to you. They're technology stocks, Apple, Facebook. They've continued to dominate, and we're continuing to see that technology, also pharmaceutical stocks, are the ones that have posted the highest gains over these last several quarters. So I know it doesn't feel this way, but as I mentioned, market volatility has actually remained low. It doesn't feel like it. So we wanted to show you this chart, and it goes back all the way to, I don't know if you can see this, it's a little hard to see, October 2007. And October 2007, we can see 2008. Well, that was unbelievable volatile, where that is essentially where we saw the prices of stocks moving significantly. We had another time in the ends of 2009 into the early year of 2010. We had a little bit more volatility in 2011. And then here we are. And you can see that relatively this time period, and for looking at the volatility of the S&P 500, we're not seeing nearly as much volatility as we've seen at other times historically. So that is good news. It means that the market is behaving somewhat. There's not big whipsaws necessarily in the prices of certain stocks. But what's interesting is that when we talk to clients, and actually how I feel, even personally, if you want me to kind of reveal how I feel like this year has been unbelievably volatile, and in a lot of ways, I'm feeling kind of tired. I'm feeling kind of tired from just that onslaught slot of volatility that's coming from the news. And I think that's what a lot of people feel is that because there's so much going on with politics, so much going on in the world, that we see that, and it really clouds our focus, and we often look at our stocks and believe they're going up and down significantly, and that's actually really not true. We're at one of the calmest places that we've been in years and years and years. Well, talking about calm, I want to talk a little bit about bonds, because that's what bonds are meant to do. Bonds are meant to have a calm performance. And what you can see here is you can see for the quarter how short-term bonds and intermediate-term bonds did. They did okay. And you can even see for the year. So short-term bonds for the year, so going back to January 1st, 2017 to the end of September 30th, 2017, we had a little over 1% return, 1.1. And for that's for our short-term bonds. For intermediate term bonds, it's about 2.7%, which we would expect. That's essentially what we would expect to see from bonds. The big story is actually international stocks. In international stocks, you can see the biggest performer here is China. China had a 43% return in their year-to-date performance of stocks on their stock market. We have then followed by several others, India. We have Hong Kong, the European, and Europe, we have great performers such as Germany, France, Spain. And then we also have both Mexico as well as Brazil. So that's where we're seeing so far in 2017 the best stock market performance worldwide. And you can see, as we talked a little bit before, that developed markets have done well, about a 20% return, and emerging markets have done even better, almost a 28% return. Essentially, foreign markets are being led by emerging market stocks. And it's been quite an interesting streak here. In fact, if you take a look at where we are right now, you can see here we've got from this year in particular, we had a low, and emerging market stocks, their prices have just marched forward. Really, really healthy growth. And what about the future? Because I don't know about you, but there's been some concerns, rightfully so, about the US stock valuations. And here you can see right here, we're looking at the price to earning ratio of the US stocks, the S&P 500. And we compared that to what the average price to earnings ratio has been over the last 10 years. And you can see that we are significantly higher. So the price to earnings ratio is much higher than it has been historically over the last 10 years. What does that mean? Well, it's just a fancy way of saying that essentially the stock market is pretty darn expensive. Pretty darn expensive. And so what you need to think about is, where should I be putting my money? And here you can see again, as I mentioned, US stocks are particularly trading above their historical levels. So what about US stocks compared to developed international? What about US stocks compared to emerging markets? Let's take a look. And here you can see right between the blue line and the really pretty teal, that shows you the difference between US stocks and then emerging market stocks. I'm sorry, US stocks and developed international stocks. That is the difference. So you can see that developed international is trading at valuations much lower than the US stock market. And then we'll also include here the difference between US stocks there in the blue and this really pretty maroon color, which is the performance of emerging market stocks. And you can see that that emerging market stocks are also trading at valuations that are really a lot cheaper than US stocks. So in comparison, US international stocks are cheap and they actually offer some really attractive long-term potential. And this is part of the reason why it's imperative. It's not a maybe. It's imperative to make sure that you have a significant exposure to U.S. stocks, but even more so that you have a significant exposure to international, both developed and emerging market stocks going forward. That is what's important. It's important to have a diversified portfolio. And why is it important to have a diversified portfolio? Well, I'm sure you could rattle off 10 different reasons, but let's start with the first one. There is going to be an interest rate hike coming up. Now, when? We will see. But based on the federal fund futures, what they're saying is that there's a 95% chance that in 2017 that we're going to see one rate hike, at least one rate hike. 74% believe that we're going to see potentially two rate hikes, and a smaller percentage, but still significant, 41% believe that we're going to see at least three rate hikes. So again, this is probability of interest rates hikes by the end of 2017. So this is significant. We know that most likely we're going to see rate hikes, not just now, but potentially going forward, not only through 2017, but also through 2018. And what do rate hikes do? Well, a few things. Borrowing money becomes more expensive. So when you go to get your mortgage, you most likely will see higher interest rates. The value of your bonds that you hold actually possibly can go down. And so having diversification within the types of bonds you have is very key because certain bonds are much more sensitive to interest rates rising than others. Banks, on the positive, may increase that paltry interest rate you're getting on your savings account. In fact, what we're seeing already, we're seeing companies like Capital One posting 1.1% interest rates for their commercial savings accounts, which is phenomenal, really phenomenal. In fact, I just moved our parent teacher association funds to Capital One to take advantage of that really awesome 1.1% rate. And newly issued bonds. So the new bonds that are newly issued will be issued with typically higher interest rates that you will receive that compared to the rates that are already out there. So there's some real positives, but also some things to think about. So why is it important for diversification? Well, we talked about you want to be diversified if interest rates go up. And that's what this chart is showing you. Right now, this is showing you how diversified portfolios performed versus all stock portfolios before an interest rate hike. So you can see this is 12 months out, 6 months out, and 3 months out. The all stock portfolio here with US stocks did a lot better versus the diversified portfolio. In fact, you can see in all these different time periods before the rate hike, all stock portfolios did better. But look at this. Look at how that all stock portfolio did after the rate hike. We can see very clearly that diversified portfolios did better after the rate hike. So if you're not diversified now, I have to tell you, now is the right time to make sure that you have the right mixture between US stocks, international stocks, as well as bonds. It's one of the most fundamentally important things to know is that diversification performs better when interest rates rise, because this is the fundamental basis of everything you need to know about making smart financial decisions. Because if you get caught up in the headlines, you're going to make the wrong decisions, typically at the wrong time. And we put together just in this last month of October some scary headlines that we saw. And I have to say, if you are a consumer of mass financial journalism, I can only imagine that your cholesterol, your blood pressure, everything must be a whole lot higher, because when you read these different headlines, if anything, at least for me, they bring a little bit of fear that's really unwarranted. And here it is, the first one: the stock market just flashed a dangerous warning signal. Some investors see signs of the stock market on a verge of a melt up. Stock market is overpriced. 3 stocks to own in a stock market crash. Again, a lot of headlines that are really flashy, and they're meant to really bring your eyeballs to their website, to their publication, or to their television show. What we need to focus on is we need to focus on what we can control. And there have been many studies done about how your brain works with money. And this gentleman, Jason Zellwig, wrote a fantastic book called Your Money and Your Brain: How the Science of Neuroeconomics Can Help You Become Rich. Essentially, training your brain to think the right way so that you don't make big money mistakes that will haunt you into your future years. Because market volatility, the ups and downs in the market, it's normal. It's part of investing. And for you to enjoy higher potential returns, unfortunately, you have to be willing to accept uncertainty. Financial losses are processed in the same area of the brain that responds to mortal danger. So, what this means, what Jason's really saying is that if you want higher investment returns for the long run, you have to be smarter and outthink your own brain. Because when you do see losses in your portfolio, which will of course happen, losses will happen. You need to be clear and understand that where they're being processed is back to that place in your brain where it's the fight or flight area. That's where that big lion coming at you, and you look at him and you either fight or you flight. But you can see that it's a very, a part of the brain that is very difficult to control. And the best way we can do that is by educating ourselves and understanding that when we react to loss in a very emotional way, most likely we are not going to make a good decision. In fact, the other thing that some people will do is they'll, like I said, look at the media. And one of the things they'll do is they'll look at magazines and figure out what stocks should I be investing in. And what's interesting, we took a look at Fortune, Forbes, and Business Week, and we looked at the 20-year period, and they had over 593 stock cover stories. So essentially, cover stories were on the cover of that magazine. It was invest in this stock. What we found is that, which is really, really interesting, the 2 years prior to the publication, the bullish stocks, so the stocks they said were going to do really well, really did do well. But unfortunately, what we saw is that over the long run, 2 years after publication, when we looked at their bullish stocks that had done so well and their bearish stocks that had performed so poorly, 2 years after publication, they were performing about exactly the same. So what does that mean? Does that mean that the best place to get your advice is from magazines? The answer is definitely not, because magazines are good at telling us what's happened recently. So you can see they can report very well on stocks that have been very good over the last couple of years and stocks that have really performed very poorly. But they're not good. They're very poor at providing insight into future performance. Because despite these two very differently performing stocks, some very poorly and some very good, 2 years after they were on the magazine cover, they performed the same way as those others that were on there. So really interesting stuff. The other one is the Kramer effect. And I don't know if you've seen Kramer, but oh my gosh, he's one of the experts in psychology really cite him as the guy most likely to push our emotional buttons and spur us to make impulsive investment decisions. And if you watch his show, which I've watched it a few times before I really get physically ill because it's so upsetting, but you'll see that there's lots of charts, there's lights, there's flashes, even animal sounds, sirens. There's a lot of emphasis on short-term investing and how things have done short term, not looking long term. It's just Jim. So there's no one really to essentially compel him to take another point of view. There's no one there challenging him about his different viewpoints. He's also a really fast talker. In fact, I think I'm a fast talker. Jim Cramer, oh my gosh, puts me to rest. And everything you can see too, and you can see even in this in this little magazine article, everything is a shade of red, which incites a lot of emotion in people. And as I said, if you don't want to have your buttons pushed, don't watch Jim Cramer, because they've actually created what's called the Cramer effect after him, because he's one of the most likely characters to push your financial buttons. Um, this is a quote. I can't believe that Steve Forbes actually said this. Of course, Steve Forbes owns Forbes magazine, one of the largest national media outlets. Magazines are meant to sell money, and he was actually was quoted saying, "You make more money selling advice than following it." It's one of the things we count on in the magazine business, along with the short memory of our readers. So magazines and publications are not always your friend. You very much want to get your news, and in a good place would be from your financial advisor or a independent news source. Something that you can do though is you can focus on what you can control, and that is letting the market work for you using tax efficient strategies, investing in the lowest cost way possible, diversifying, and staying disciplined. Why is this important? Well, we looked at the performance of $10,000 between January 1997 and December 2016. So if you remember during these times from 97 through 2016, we've had some bumpy roads. First, we had the dot-com bust in 99. Then we also saw the market meltdown of 2008. And those people that stayed fully invested during all of those turbulent times eked out a pretty amazing return, a return of 7.86% on an annual basis. Those people who are fully invested. You can see that those that missed the 10 best days during those years only had a 4% return. Missed the 20 best days, had a 1.5% return. And so those that stayed out of the market after those significant drops, look, they're still negative. They're still negative and not able to fully recover from those market tanks. So it's really important to stay invested in market downturns. In fact, what you can see is that missing only a few days of strong returns can drastically impact your overall performance. In fact, this is a wonderful chart. Essentially, what this shows you, it shows you how significant portfolios have rebounded after some very turbulent times. And we can see right here after 2001, so after the terrorist attack, those that 1 year out, they were still at a loss. But 3 years out, they had a 40% return. 5 years out, look at that. 5 years out, 81% return. You can see here, September 2008, 1 year out, a 4% return. 3 years out, 12% return. 5 years out, a 47% return. And this is true. This is true not only for these two market downturns in 2001 and 2008, we can also see it in all of these other areas. October 1987, August 1989, September 1998, March 2000. So you can see very clearly that in both good times and bad times, we want to remain disciplined. We want to remain staying in the market. So it's really important. It's really important that you have the right investment philosophy. And we have three key tenets to our philosophy that guide all the decisions that we make. You can see that we believe the smart way to invest is by using emotion free proven investment formulas. By eliminating emotions from the investment process, our clients can invest confidently, knowing that each investment decision is rooted in academic research, not based on emotions. We approach investing with the goal of producing the best possible returns consistent with each of our clients' level of risk tolerance, with the lowest cost as well as lowest taxes produced. And finally, our third tenet, we see the portfolio as a big part of the foundation for your financial security and for your long-term growth. Again, those three tenets of emotion-free investing. Number two, investing with the lowest costs and lowest taxes. And three, that portfolio that you have is really the foundation for your financial success. And if you have any questions, we have our second opinion service. 80% of individuals who were interviewed who said that they'd like to have a second opinion. And actually, I understand it. I went through with knee surgery and I wanted to make sure that I was doing the right thing. And you bet I got a few opinions from different doctors before I went under the knife. And I felt much more confident about that original game plan that we had, that I would have knee surgery. So the great news is I'm running up to 5 miles, I'm going to boot camp, and I'm doing really, really well. And like you, my goal is so that you can feel comfortable with your investment portfolio. So feel free to reach out to us if you're not a client already, to have us review your current situation, look at your investments, look at, are you on track with your financial goals? And this is no cost. And we do this on purpose without any cost because we may not be the right planner for you. And it could be, quite honestly, the fact that you're really well diversified with your current planner. We can let you know that. And you're happy with your current planner. There's no reason to move. You don't want to move financial advisors unless there's a really compelling reason to do so. So if you have any questions, please do reach out to us, and you can email info@francisfinancial.com. You can also email me, Stacy, STACY, at francisfinancial.com, or you can call the office, and that's 212-374-9008. Here's all our contact information. We've got Twitter, Facebook, anything. You can also visit our website. The website actually has some great information, www.francisfinancial.com, about the second opinion service and also about our process. So thank you. Have a great day and happy Monday.